Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. Now, to sign up to either Chen's letter or mine, go to miningstocks.com, or call our number in New York at 718-457-1426, 718-457-1426. Call that number during normal work hours in New York City. But now, Michael Oliver is with me once again to update us on his latest views on some key markets like stocks, bonds, and precious metals. Thanks for joining me again, Michael.
Great to be back.
Always good to have you. I'm sorry it's been too long. Seems like several weeks since we last talked. But let's jump right into it. Your weekend missive that you send out to your subscribers. And before we get started, I want to let my listeners know it's OliverMSA.com. Oliver, O-L-I-V-E-R, M as in Mary, S as in Sam, A as in Albert.com. Go there to learn more about Michael's excellent work. He sends out many different missives during the week on many different markets. We tend to focus on some of them that are the most directly related to what we talk about on this show. So let's jump right into the stocks, the stock market, Michael, the S&P. Based on your structural momentum work regarding the S&P, you have been warning all through 2015, at least during the second half of the year, that the equity markets were topping out. Then, more recently, your work indicated that the bull market is definitely over. In your weekend report this past weekend, you showed a definitive break in your monthly momentum chart that even the most novice investor can see clearly that stocks are in big trouble. You expected a bit of a rally this week, Michael. This is only Tuesday, so we've got a ways to go yet, but there isn't much of a rally so far. Do you think we may still see something on the upside this week? And if so, where might we go? And if not, where are we headed on the downside?
Much of the rally, of course, was last week, and I think there's some extension this week was in store, and we only extended, I think, about 2 or 3 points yesterday at the high.
Yeah.
I'm actually looking for this week to sort of probably peak out. Again, that's a short-term type analysis, and so when you try to fit short-term with long-term, the short-term can sometimes be tricky, but my guess is the rally runs out of steam soon. And frankly, from a long-term momentum structural perspective, and I look at trends primarily through the momentum of price, not price itself.
Sure.
I think there's a difference there. You could rally all the way to 2,000 in the S&P and it wouldn't impress me. I mean, so it's basically an irrelevant rally. It's a futile rally. You've done the damage. You've blown the bridge up. And price, naturally, if you'll recall in early 2008, for example, first thing you did in January is drop 200 S&P points. Back then we were dropping from the 1,500 level. And then you turned around, did a base, and rallied all the way back up into May and almost got unchanged on the year. That was the high of the year. And then you fell apart. But the damage had already been done in January, so it said, you're dead. Rally if you want, but it's futile. And that's effectively what we're getting here. That's what we had in August, and it was futile. The recent low, to me, is meaningless. It did not hit anything that justifies lasting support. That was the low 1800s that we got to a few weeks ago. And so the rally is just, I think it's desperation. Partly it's anticipation of central bank action. And of course, the BOJ did just that.
Right.
They ambushed the market with a 5-4 vote, and they emphasize that. When's the last time you ever heard the Fed being split that way?
Right.
Usually it's one dissenter. It was a 5-4 vote. 4 of the people on the BOJ are dissenting vocally and intellectually in the open against the entire policy. They don't think it's worked, and they don't want it to continue, but they've now driven rates to negative. Abe is no doubt happy. But my bet is the yen has turned, and that's what upset them. The yen early this month went up and took out last year's high. I look at yen futures, and I no doubt that upset them. And so they came in on last Friday and ambushed the market back down slightly on below where it closed last year, and we're starting to firm up again. I think if the yen continues steady this month, it's in effect saying a Bronx cheer to the BOJ. Your desperate effort will not work, and I think it's important. Because if the dollar can't strengthen, and so far the dollar is where it was a year ago, more than a year ago, it has not gone up. People keep talking about the strong dollar. It is not strong. It is at best trading range. If you engage the euro, and that's another variable, Euro right now is at 109 plus. You get much up around 111, and something's going on. The euro could engage in the upside, and I know that flies in the face of a loose ECB.
Right.
But sometimes technicals work out differently than the obvious fundamentals. So we have the BOJ and the ECB trying to keep their currencies down, yet I'm seeing technicals that indicate the opposite could be occurring. And if that occurs, it's very upsetting to a lot of things. Meanwhile, while the stocks rally, how come the following two events occurred? T-bonds continued to rally, flight to safety vehicle. Why is money still flying into T-bonds?
Right.
And two, gold has been upticking more than the S&P in the last several weeks. In fact, the gold S&P spread out over the last 5 or 10 years, looking at the spread relationship, the relative performance relationship, in my view, broke out at the end of January to the upside, meaning gold is now a stronger asset to hold than the S&P 500 going forward, and probably for several years. And I find it fascinating that while the S&P's had its fierce, hopeful rally, gold has advanced, let's see, $40, $50, $60, $70 at the close of the year.
It's kind of a stealth, sort of a stealth bull market. I don't know if it's too early to say it's a bull market, I guess. Where do you see sort of what sort of
1140 to 1170 zone is a minefield for gold. You get up in that area and it's a bull market. We break through 1130. So,
you know, Michael, it reminds me a little bit of somebody on death row that's trying to postpone the inevitable, and they go back to the courts, they go to the governor, they go here, they go there, and if that's what the Bank of Japan is trying to do, we'll see if the Fed reneges on its interest rate rises. I wouldn't be surprised if we see the guys coming out talking about negative rates now. It looks like the propaganda artists are getting the American public ready or trying to for negative interest rates. I've never seen anything so crazy in my life, and I've lived quite a few years, as have you. Would you agree with that? That it's crazy?
Negative rates, that's really a thumper there. If you'd have suggested that 10, 20 years ago, even the people who advocate it now would have thought you're nuts.
It's absolutely nuts, and I remember, when I was doing my economic studies at Rutgers, I remember this topic coming up of how there were negative interest rates during the Great Depression. And here we are again with negative interest rates, and it's being championed as an answer. I don't think it's going to work, but we'll rely on your technical analysis to tell us whether it is working, Michael. I know you like to let the numbers, keep very objective that way, rather than keep the emotions out of it, right? Oh,
well, you go nuts otherwise,
Yeah, yeah.
The flows
I think you're right.
Sometimes seem so confusing, and it's if you focus on the fundamentals, you'll find contrary ones here and there, and it's hard to put them together and decide which one, hierarchically speaking, is more important than the other. So I don't do that. I rely on the momentum of price and so forth to tell me which way the flows are going.
Yeah, well, the dollar chart looks a little bit like the S&P over the last year or so. I guess it sort of just can't really get anywhere on the upside, but yet it has everybody believing it's in a bull market. It's interesting. Let me just ask you one more quick question, and maybe in the next minute, if you could tell us, what do you see for the gold shares now?
I still like the gold shares more than I do for, gold in terms of, I'm watching gold because it's the papa. If it breaks out, you want to look at silver and gold miners. Now, I referenced the GDX, but you could look at because that's an unleveraged ETF of the larger gold miners.
Sure.
There's other ones as well that, have more bang for the buck, the juniors, and some of them are levered. But just using GDX as my reference point, it's trading at 14.5 area. I close out a week at 15. I would begin to buy. You close out a month at 16, I would be fully invested. I think the percentage potential upside gains in the GDX could be the biggest trade of the year. And again, I state that as a percentage gains. Part of that is due to the fact that it was so vastly oversold.
Sure.
I mean, it used to be $68 several years ago.
Yep.
And it came down into the 12s. And so just on a bounce effect, thin air bounce,
you could get a double.
A huge percent. You could double it in a heartbeat. Yeah. And I don't see major resistance until 40.
Interesting. Very interesting. Well, we'll have to let it go at that, Michael. We're out of time. As always, so good to have you. Glad to have you back, and we look to talk to you as often as we can squeeze you into this limited time we have on this show. But thank you so much for being with us once again.
Always love it, Jay. Thank you.